Maverick traders, welcome out to your market roundup, August 23rd. Corey here with you. Make sure you follow your trading plan. So let's take a look at the markets. Last week we talked about how, in my opinion, we're still in a bear market. We'll reiterate that a little bit today. Short-term uptrend in a long-term downtrend as I see it. You can see that we don't have the 200-day moving average, but it shows the same thing. So today was a little bit of a pause after yesterday's selling. That's pretty commonplace. When you have a big move like yesterday, the next day is usually kind of a harami type candle, just a little, candlestick that kind of overlaps with the prior day, a little bit choppy and quite sideways. Today, oil was on the move, oil up big at 3.5%. And when we get to the heat map, you'll see bright green in the oil space. On the daily news, Twitter, there's a whistleblower alleges that executives and board members misled investors. This could disrupt the Elon Musk takeover. That's a possibility. And then existing home sales, and really all of home sales data has been terrible. Existing home sales down 20% today. Pretty ugly performance there. As we look at the advanced decline line, about half and half today, as you'd expect. And then the 50-period moving average has given back some of its bullishness. Now we've got 35% of stocks below the 50, 65% above. As you look at the S&P chart, you'd say, well, we've been rallying. What's the problem here, Corey? The problem is we came right into the 50-week moving average, 200-day moving average. It basically, we've come up in a corrective phase, and look at how sharply we're selling off. So in my opinion, the next trade, the next opportunity is when you come up and hopefully get a little rebound to kind of fill that gap. My expectation is that we will probably fail on that gap fill and then roll over again, creating a little bit of a short opportunity, a lower swing high. You could probably add to that bearishness as you come down and take out the lows and so forth. So I'm expecting a mild bounce, but I would anticipate that we now create a series of lower highs and lower lows, and a small kind of weak bounce would be just what the doctor ordered for shorting. Let's put context around that. So last week we talked about this. Look, I'm personally bearish. You've come up underneath the 50-week moving average. When you're above this 50-week moving average, you're in a bull market, and you were in a bull market in stocks for almost all of 2020 post-recovery, right? So we had the 2020 decline in COVID. You got back above that a few months later. From there, bull market, bull market, bull market, bull market. Now, there were short-term downtrends. Here's a 4-week period where we dropped 2 weeks down, 2 weeks down, 2 weeks down, 4 weeks down. That's no problem. You'll have short-term little downturns or corrections. It turned into a bear market right in here. This is where we turned from bull to bear, right? And so this rally that we're seeing, it's a correction in a bear market. That's the way I look at it. You could look at other types of approaches. You could say, well, what do the Elliott waves show? Well, here's one wave down. Here's 2 waves back up, lower high. Here's a 3rd wave down. Here's a 4th wave back up, lower high. Here's the 5th wave down. Okay, that's the end of that downtrend for now. And so you should go in an ABC style correction, right? 1A, 2B, 3C. And that should be the end of it. And now what do? We probably head in this direction. So it just fits in so many, you put context around price action and you try to make sense of these things and you try to weigh the evidence, right? And more of the evidence, in my opinion, suggests we're still in that bear market. So do you want to be shorting it all the way up? No, you wait for some indication that we've hit resistance, that we're rolling over really the characteristics we're seeing right now. And so are we putting on more bearish trades than bullish trades? Are we starting to layer in and so forth? I think that makes complete sense. So from a market perspective, do I expect us to go back to those lows? I do. Do I expect we'll probably take out those lows in the coming, months ahead? I do. It won't go in a straight line. Don't get me wrong. It's going to be choppy. You're going to have up days. You're going to have some big rallies mixed in, but the general path of least resistance, I still think, is on the downside. Now, that's not true of all sectors. We've talked about energy looks fantastic. Energy is having a fantastic year. It had its own correction, but its drop was a downward move in a bull market. So where the majority of stocks are in a bear market big picture, energy is not that way. Energy is well above its 50-week moving average and so forth. In fact, the recent correction took it back down towards its 50-week moving average, and it bounced right where it should have. It held right there. It looks fantastic. We've been highlighting a few of those names. Occidental Petroleum, which is up big, 6.9% today. We'll touch on that one more today as we speak. So for this week, the rest of this week, I'm expecting, hopefully, I'm kind of crossing my fingers. I hope we have a mild bounce where I can get even more short. Now, as you look at this has turned red, right? We're now below the 20. I think we could bounce back above it, and that's fine. That's just choppiness. We're above the 50. The short-term trend is not in a downtrend yet. My take is it's going to be in the not too distant future, right? As price action leads, those moving averages will start to roll over and follow. It'll take some time, but I can't wait for the moving averages to look perfect. I think in this case, it's a realignment trade. If I'm confident the bear market is what it is and it's held where it held, then I've got to kind of look at this and say, okay, when this starts to roll over and make lower highs and lower lows, I'm going to start to short even ahead of those moving average reversals. That's the way I'm personally going to play it. If your trading plan says to wait and see more confirmation and get a full trend reversal and so forth, then by all means go that route. We'll talk about some new bulls, some neutral, and some bears. Let's get into it. So first on the bullish list, EWJ. This is a Japanese ETF. So if you look at EWJ, I think we're just in kind of an ascending triangle, somewhat of a choppy pattern. The reason I wanted to highlight this is more that I think it will outperform US markets. Not so much that it's a screaming buy right here, right now, but to kind of say, let's look at the international space, which has been left for dead, by the way. Which has a tendency to underperform in certain markets and outperform in others. And the big run higher in the US dollar has been an issue for international stocks, but I suspect that they will start to outperform in the near future. So I'm looking at things that are in a bit more of an uptrend. OXY, we've been highlighting for some time. I mentioned this one last week, this little cup and handle. And what I really liked about it was the news. I liked the fact that Warren Buffett and Berkshire Hathaway went above that 20% level in buying. They own, as soon as they bought and owned more than 20%, the odds of them buying out the whole company skyrocketed. That is a major shift. And so then we talked about this. I've been buying this personally back previously, and I've done it. I've traded this over and over again this year to the upside, and knock on wood, every one of my bullish trades has worked. Currently, I have 2 bullish trades on, by the way. If you look at the interesting aspect of this is that the market, even though I think that kind of should have been obvious as soon as they went above 20%, that's a big deal. The market was slow to catch on, and the news then came out that they have sought ability to own up to 50% of the company, and they got approval to do that. Now, they can't have a controlling stake, but they're buying more of the stock, and they've got approval to own up to 50% of the shares. That means that they could more than double their current stake and so on. And on that news, rightly so, the stock skyrocketed. Now, I liked it a heck of a lot more at 63 than I do at 73, right? That should kind of go without saying. But here's a little homework assignment. Go pull up maybe a 15-year chart, 20-year chart on OXY, and look at how many times it's hit this level. This was the level we talked about that it could go back up to, and it hit here in 2011 and 2007 and all these different years that it failed right at this level. It's basically on the cusp of new all-time highs. Does it make sense to take a little off the table at resistance? Maybe, but this is something that could absolutely skyrocket on a move to new all-time highs, new multi-decade highs, etc. That's a classic breakout candidate. So a lot to see there, a lot to digest, but it continues to work. TTD, this is Trade Desk. They're a competitor to Google, which is usually not a good thing, but interestingly enough, they were the standout performer on earnings compared to Google, compared to Pinterest, compared to Twitter, compared to all these other companies that do advertising. This company hit on all cylinders. I think it'll have a little bit more downside, and here's what I'm personally watching for is a little flush to the downside. If I see a big bearish candle, you might think that's bad. I think it's good. I think that will show that basically anyone that's willing to sell what's already been selling off for a number of days, I want to see a flush out, and a big bearish candle would do that. That would basically tell you, okay, they pushed people over the edge. People have given up. They kind of threw in the towel, and that should mark the bottom, and I'll trade it back to the upside. So I'm looking for a flush. We don't have it yet, but that's what I'm personally looking for on that one. Simon Property Group. So this one's in our neutral list, and I've had it there for a few weeks. The day we highlighted this first as a neutral candidate was this day. What's interesting about that day right there? Huge bearish engulfing candlestick pattern, but in an upward trend. See how it was reversing into an uptrend? So you were above moving averages, but huge bearish reversal. It speaks to indecision. It speaks to a lot of sellers, but there were also enough buyers to push it up. And this is kind of what I look for is conflicting factors there, confusion in the stock, and so it's a neutral candidate. Look at where it's back to. A few weeks later, a couple weeks later, and we're right back to this level. That's how you trade neutrality. You don't put on a neutral trade and expect a stock to do this. Stocks don't do this for very often, right? They don't just go sideways day after day after day after day. The only charts you'll see that look like that are when a company's getting bought out. It'll gap up towards the buyout price and then it'll just flatline. So that's not something you can trade for neutrality anyway. Everybody knows once the buyout's announced that it's going to flatline somewhat in that level. That's the only time you'll really see that chart. On individual stocks, you might see it for 4 or 5 days, right? A high base, a low base. But for it to just go sideways for a few weeks like that, impossible. What sideways means is that although it's going to move, we think it's going to find its way back, right? It's going to move away for a bit and find its way back, or move away for a bit and find its way back. That's what a neutral trade is. Now, here's the problem. It is neutral. It's found its way back. Do we stay in it and expect it to, go away from here again and find its way back again? I don't think I can fall in line with that. We had the perfect trade, a neutral expectation. It found its way back. At this point, I think I would take off the trade, lock in the profits. If you had a neutral trade, it should have some profitability a few weeks later as you're back at those same price levels. I think I would lock that in and take the gains at this point in time. Bearish ideas. So I'm not bearish on energy stocks. This is Baker Hughes. But I do have to say that if I were going to be bearish, and here's what's kind of interesting to me is how much this is underperformed, kind of filled the gap, and even today fell off the highs, not keeping up with its competitors and its peers and so forth. And then it's also kind of interesting as a little bit of a hedge. Sometimes, like I own a lot of energy trades to the upside. So I'm definitely overweight bullish on energy. I've been playing them higher, and it's been working. I can take profits on those. I can just close them out, or I could look at something like this and say, well, adding a bear here in energy might be interesting to kind of, take a little profit on this. Yes, but also adding a good bear, I might make money on this one going that way, which will help if any of these start to falter, that sort of idea. Now, that's not always the best way to play it, but I think this is a space where energy just made a big run, and I'm seriously considering adding a bear like that has vastly underperformed. GLD. Here's gold. We talked about Newmont mining. I've had that on the bearish list for a few weeks. My suggestion in how I was trading it was for a sharp, quick move and take a quick profit. So if you traded Newmont mining, hopefully you did just that. It certainly surged to the downside, and you can just take that few buck move and move on. In GLD, I think you can be a little bit more patient, maybe another day or two of upside, but ultimately I think we're headed, and it'll take some time, but headed back towards these lows. So this one, as opposed to Newmont mining, where I was just looking to kind of take a quick profit when it had that spike down, this one I think you can just kind of settle in, play it as a neutral to bearish type of position. This tracks gold prices, and there's just no buyers for gold and silver right now. Is just not a good environment for them. I suspect this will continue to progress to the downside. And then we highlighted some large cap healthcare names, talked about shorting them on the bounce. So both Bristol Myers and Johnson & Johnson, large cap healthcare, they bounced last week and were perfect shorts. I mean, quite frankly, we're getting basically J&J now, and Bristol Myers has already broke down sharply, BMY. So we filled the gap here. We had the bounce. I think you could be just getting into this, but it should keep working its way that way. Bristol Myers, BMY, you could already be in that bearish trade. It bounced a little bit last week and has been selling off for a few days since. I think that one looks good as well. I'm not really bearish on biotech, but more large pharma. Johnson & Johnson, Bristol Myers, they look bad, but a lot of the biotech, they trade a little differently. So that's kind of two groups. You've got large pharma, and then you got biotech, and biotech certainly looks more bullish to me. Markets are still in a bear market as I see it. This was what we talked about last week in the market roundup for me. Talking about it more this way, I think another push towards the lows, but it'll be choppy. It's not just going to go straight down. Preliminary GDP comes out on Thursday, and then the Jackson Hole Symposium starts this week. The one thing I remember about the Jackson Hole, there have been a few times where that has been a big mover for stocks, and the one that I always remember is when Bernanke, this was, a few Fed chairmen back, but he for a long time had given guidance that they would not stop quantitative easing, money printing, bond buying programs until unemployment hit 6%. That was their target. And then when unemployment went down to 6%, what did they say? Oh, that was an outdated target. We're still going to keep QE. We're still going to keep our bond buying program. We're going to keep doing this. We set that target. Now we're going to remove that target because it's outdated. And the markets just went crazy to the upside. I don't know if this week's going to have some big event, some big market moving event. My thought would be it has more risk than reward, that there's more a chance that the Fed is going to be hawkish, that the market's not going to like it, than some major surprise to the upside. I just don't think the Fed can screw around with inflation. So there is more downside risk, I see it, than upside risk. On the earnings calendar, Salesforce, Dell, Dollar General, Nvidia, Snowflake, VMware, certainly quite a few companies reporting. Some of them highly volatile, like the Nvidias and Snowflakes of the world. So be aware of those if you're trading any of those names. I hope you enjoyed this market roundup. On behalf of Maverick Trading, I am Corey Halliday. We will see you next time. Goodbye, everyone.